John, what is the backdrop here for global bond yields, and what is the connection to the average trader and investor? Tell us why they should care.
Yeah, I think this is a bit of a warning and also a lesson to the Fed, particularly that cutting short-term rates doesn't necessarily mean that all interest rates are going to fall, and long-term rates do have a more impactful um, bearance on consumer uh, debt, corporate debt, and governing borrowing costs. So the conditions in the UK are very similar to what is going on, according to the Fed, in the US: slowing growth and sticky inflation. And the BOE and the European Central Bank have been cutting short term rates, and yet we're seeing G7 long term bond rates go up. We're seeing them going not only in England, you mentioned Japan, but France, Spain, Italy, all of them. So, what does this really mean to us? And I think what it is, it comes down to supply and demand. So, first of all, let's talk about supply, right? Increased deficit spending. A lot of these European countries are now being required to spend a lot more towards defense. Um, that borrowing means that they're going to issue more debt. Um, and that is increasing the supply. Um, if we think about short-term rates, right? Cutting short-term rates does not necessarily mean that rates are going to come down. It actually might put pressure on, or at least increase the exposure to the long end of the rate curve. So that is the bit of the supply side. On the demand side, what we're seeing is that, I think you had a tweet a couple of weeks ago or a week ago where you said that we are in like a 60-month drawdown of government issuances, right? In other words, folks are not buying government debt, not necessarily US debt, but debt in general. That
Yeah,
has been
exactly, John.
happening.
Yeah, that was a 61-month drawdown by far, John, by far the longest drawdown in history.
Well, so what does that tell us? Is there's a reluctance to buying G7 debt. Again, that's the demand side, right? So more supply, less demand. That means prices have to come down, yields have to go up to make it more attractive for somebody to take on that debt.